Welcome back, everyone, and thank you for joining us again today. I'm your friendly neighborhood PM, Clayton Allison, here with two of our leaders at Prime Capital Financial, our Chief Investment Officer, Scott Duba, and our Deputy Chief Investment Officer, Will McGough. We're here to bring you the next latest topic of what's going on in the markets. And before we get started, before we kick it off, please go ahead, scan our QR code, follow our link for your free resource, as always. But you all probably guessed it, it's more turmoil going on in the markets, more or so less related to the Fed versus the administration currently at this current moment, and we're seeing markets react accordingly. So without further ado, let's dive right in. Scott, why has the administration been calling for Chairman Powell to get fired?
Well, I think the firing specifically is unique, but White House pressure on the central bank is not a new phenomenon. If you look back over history, there's been multiple administrations that advocate for lower rates. Lower rates tend to make things less expensive to finance and tend to stimulate consumer spending. So with what the administration is trying to do with respect to tariffs, that's creating some uncertainty in the markets, that's creating some potential possibility of economic weakness, and the administration is siding with a lot of economists that are suggesting that rates are currently too high, and is, like a lot of former administrations, pressuring the Fed to be a little looser on monetary policy by lowering rates. Now, the unique part is the actual calling for a firing of a Fed chair. I think that's a bit unique, but that's kind of a normal week in the markets lately.
That's perfectly well explained. Now, I guess make it simple for me to understand, why were the markets reacting so violently, both of you guys?
Yeah, I'll start with that one. So if we go back to April 16th, it was a big down day. To start the day, we had come off NVIDIA earnings just prior to. So there was already pressure on the markets. Fed Chairman Powell was speaking, I think, at a Chicago event, and essentially said there was no Fed put. If you guys remember, the bull market post-global financial crisis was really Fed governors marching out one after another anytime the markets pulled back. So we got conditioned to what was called the Fed put. Which meant anytime there was uncertainty, markets were down, you could pretty much count on the Fed reducing interest rates to spur upside in the markets. It's obviously not the case right now with the regime that we're in. And then on April 21st was the famous tweet now from the administration about firing Powell. And so that's caused more of a sell-off from the markets. And we're simply trying to find the bottom here, in my opinion. Markets typically try to retest the lows before they move higher. There are some occasions like 2020 where we do create the V bottom. But in my opinion, the volatility at this point is healthy as we're retesting those lows. And ultimately, we'll get some positive catalysts here soon, in my opinion.
Thanks for that info, Will. Scott, do you have anything you want to add to that? I mean, you said it's a unique situation. Obviously, the calling for Powell to get fired. Obviously, the markets didn't take that too well.
Yeah, and I think you could see the response in some other type of store value assets that don't traditionally move the way they have over the past week. Gold and some digital assets moved rather sharply higher on the news of the administration threatening to fire Powell. And I think that's just a reflection of the marketplace looking for potential stores of value if, in fact, you did get some change in the relationship between the White House and the Federal Reserve. Some of that's moving back now that the administration's backed off on some of those threats to fire the Fed chair. But I think the market is showing you kind of where the concern lies.
Gotcha. Thanks for that explanation. So obviously throughout history, a big thing about the Fed is that they have always been independent of the White House and political pressure in that regard. So if we start to see some perceived weakness in the Fed's independence, what's that do to the credibility of U.S. monetary policy?
Yeah, I think you got to rewind the clock and just think about why the Fed exists. So the Federal Reserve was created over 100 years ago, really in response to banking crises, to be a lender of last resort when banks were seeing runs and there needed to be someone to back up the deposits at local banks. And their mandate has evolved. In particular, during World War II, the Fed was less independent from the federal government. The Federal Reserve was in a lot of ways suppressing or using monetary policy to support financing World War II. As you got into the late 70s with the Nixon administration, you kind of reached this new regime where even though the US dollar was no longer pegged to gold, it was still the global reserve currency. So oil contracts, global foreign exchange, a lot of things ran through the dollar. And one of the linchpins of that was a dependable, stable currency in the U.S. dollar. And having over 100 years of relative independence with relatively stable and low inflation and bouts of the Federal Reserve willing to raise rates to fight inflation, that created a lot of confidence in using the U.S. dollar, the greenback, as a global currency. And when you sort of shake the foundation, or at least threaten to shake the foundation of Fed independence, that will naturally lead to investors worrying a bit about whether or not the U.S. dollar can continue its role as the global reserve currency, and whether or not U.S. assets will stay as well insulated from inflation as they have historically, since the Fed's been pursuing their dual mandate of full employment and low inflation.
Yeah, so just being down in Georgia, the one thing I would add is that the Fed was created over 100 years ago in Jekyll Island. So it's a little bit of trivia for you guys out there.
Interesting fun fact of the day right there. Well, like you said, Scott, the foundation got shook a little bit, but the administration did since come out and say that they have no intention of firing Chairman Powell. But we all know his term kind of comes to the end next year. So let's play a hypothetical scenario here. Powell leaves and they appoint a new chair that's a little bit more friendly with the current administration. What does that kind of do for the outlook on rates and inflation risk going forward?
Yeah, so I would simply say that the Fed has historically trailed prevailing market rates. If we look at the 2-year Treasury right now, it's about 3.8%. Fed funds is 4.5%. So whether it's Powell sometime before his term ends or potentially a new governor coming in before then, the likelihood is that they're going to be lowering rates. The ECB has cut a bunch of times lately. And so if you listen to the market and follow their peers around the world, rates are going lower, and they're just hung up on this inflation, potential future inflation, which is not data dependent like they've said for the past 15 years. The other interesting thing to me is they're, again, marching governors out left and right. Just looking at my Bloomberg terminal, typing Fed in, I want to say almost every governor has been speaking over the last week, which in my opinion is a positive sign. It's like a super tanker. They're getting their message out there so that the market can start to react to it. And right now their message is not friendly to the administration, and we'll see how much the administration's rhetoric will change the talking points of the Fed going forward.
Yeah, and I would add that whether or not Chair Powell is reappointed or someone else new comes into that seat, there's a lot of layers between the White House and actual short-term interest rate policy. The Fed governor, the chairman of the Federal Reserve is one of 7 voting members of the FOMC, so it's a committee. It's not one person that sets rates. So it is really just one voice that, granted, has some informal influence on policy, but it's a governing body of many economists, many central bank presidents, or many Federal Reserve regional bank presidents that vote on rates. So number one, it's not one person that makes the call, and number two, it depends a lot on the candidate. The chairman of the Federal Reserve has to be confirmed, and so when Powell eventually leaves the seat, there'll be more scrutiny on the new coming candidate. But if history is any indication of what the future will hold, these are typically well-credentialed people that understand the dual mandate. And to Will's point, maybe they shade a little bit more into the accommodative, dovish realm of Fed policy. But this isn't a binary thing where the White House could potentially just insert one person to effectively, do whatever financial policy or monetary policy the White House wants. There's many layers, and there's a lot of kind of built-in structural things to kind of keep the Fed as independent as possible and to keep the monetary policy as solid as possible for the future.
I think that's great insight. Like you said, there's a lot of checks and balances that go into that, and it's really a group decision. It's not just solely concentrated on Chairman Powell and what he wants to do. So from that perspective, and pivoting more towards strategy, is there anything from a strategy standpoint that clients could be doing to mitigate any further risk, or is a lot of this more headline turmoil going on right now and they should stay more diversified throughout their allocations?
I'll take the first go at it and would love to get Will's take as well. Look, we preach diversification and we preach long-term investing. There's always going to be bouts of some uncertainty, some topic du jour that wobbles the markets. But as long as you've got a diversified portfolio of high-quality assets, you're fairly insulated from these type of concerns. Not to say that inflation isn't bad and could have some macroeconomic implications, but the key is, it's why you own both fixed income and equities. A fixed income portfolio pays a set coupon, typically, a finite dollar amount that does not adjust with inflation. So if you buy a 10-year bond over 10 years, you're going to get a certain coupon payment on that bond for 10 years, irrespective of whether or not rates go up, rates go down, inflation goes up, inflation goes down. When you buy an equity in a firm that is profitable and generates earnings, they're generating revenue and profits in nominal dollars. So typically, their top line, their bottom line will move with inflation. So as long as you have a diversified portfolio and you own high-quality assets, you're relatively insulated to this. But obviously, inflation is never a good thing, and the hope would be that we continue to have a regime of relatively low and stable inflation.
Yeah, that's a good answer. And so, Clayton, what I would say is my kids love to play the what if game. I don't like to play the what if game because multiple layers of what if can start to take place from there. So what if the Fed loses its independence? Well, we'll figure that out if and when they lose their independence. What we know now is that there's more likely a chance that rates come in a little bit. And as Scott just mentioned, being diversified and having fixed income investments means you'll get the yield that prevails today plus some appreciation in bonds if rates do come in. So it's all about working with your advisor, ensuring you have a prudent asset allocation that is diversified between stocks and bonds. So that way, in whatever rate environment, and the more likely one here is, again, rates come in, you're positioned to have a buffer to your portfolio if in that Fed independence causes more equity volatility. So it's, again, the market environment we're in. If it changes, we'll probably be doing another one of these videos to let you guys know what's changed and how we're adjusting to it.
That's perfectly well said by both of you. And there you have it, folks. Like they said, make sure you're conversing with your financial advisor. If you have questions, make sure you're reaching out to them, staying invested, staying informed. And before we sign off today, I want to make sure to remind you, like I said earlier, please scan our QR code. It's a free resource for you to utilize. And we are down a member today. Our Chief Marketing Officer, Tara McBride, is not here, so I'm poorly filling in for her. But as always, we are here to keep you informed and help you navigate any twists and turns in the road. So as always, we'll be here with the next video on the next upcoming topic. But in the meantime, have a great weekend and we'll see you soon.